This is Mike Carr. Thank you for joining me for this week's look at the market. In this week's update, we'll be looking at charts that are current as of Friday's close. To start with, I want to look at why I was wrong about the recession. At the end of last year, all of the data pointed to the very strong likelihood of a recession, and that changed suddenly, and I want to take a look at why that is. And then I want to highlight how this is a dangerous market, but it is tradable with some significant upside potential. Let's start with the charts. And the simplest price action involves determining whether there's new highs or new lows. New highs are as bullish as it can get, and this chart is extraordinarily bullish. We're above the moving averages, we cleared resistance, prices are moving up. It's a bullish chart on the S&P 500. Breadth, the number of stocks that are above their 200-day moving average, sits at about 70%. So 70% of stocks are in long-term uptrends. That's also bullish, but it's not excessively bullish. In other words, this is the kind of number that could support a long-term uptrend as we move towards a higher and higher percentage of stocks that are in uptrends. Shorter term breadth, this is the number of stocks that are above their 50-day moving average, also about 70%. This is the sweet spot. This is where we have a lot of stocks participating in the bull market. They're pulling the index higher, but there's not so many that there's no room for growth. So price and breadth look great for this market. We're keeping an eye on the NASDAQ 100. It's now at new all-time highs. When the IPO market becomes excessive, we're going to see money flowing out of the NASDAQ 100 and into the IPO market. That's not happening yet, so we still have a healthy market. Breadth on the NASDAQ 100 confirming that, 76%. A little bit high, but not excessive. So we definitely have room on the upside. Now, if you recall at the end of last year, towards the middle of last year, I was certain we were heading for a recession, and all of the data pointed that way. But something happened. The Fed, surprisingly, engineered what looks like a soft landing now. It seems like Trump started telling the Fed they needed to act. Rather than acting, Chairman Powell came out with some very strong statements indicating they weren't going to act. It had the same impact as action. It actually had more impact because simply his words didn't do anything in the economy. It shifted sentiment. And then we saw the economic data turning positive as a result of what I'm calling stealth tax cuts, which improved the financial health of a number of households quietly without anybody really noticing. And I have data to show what I mean by that. Fundamentals remain bearish, and we'll look at that in a moment. Stocks are overvalued, but that doesn't matter. There's a bullish outlook right now. There's a lot of cash on the sidelines, and that cash is going to be put to work in the market. As that cash is put to work in the market, it's going to drive prices up, and we're going to see sentiment alone can drive a market. So, biggest thing to happen was simply Powell came out and said, we're done, we're on the sidelines. By stopping what he was doing, the economy became healthier. And one of the reasons is just there was a lot of cash in household budgets that became evident here in the first quarter of this year. So if you've been following the news, you're seeing a lot of headlines about bad tax refunds. And I have a few of them there. It's important to remember, average tax refund was down 2% last year, which is a difference of $55 total. Average refund $27.25 instead of $27.80. $55 difference, not that big a deal as far as the typical household's consumer spending. Lots of bad headlines, lots of bad press, but here's the data from H&R Block looking at what happened. And what they found was, yeah, the average refund's down $55, but the tax liability is lower. In other words, households were getting this increase, and it's maybe $25 a week, $50 a week, in that range, that families were taking home. And they're seeing now it's real. It took a while. That was such a small change. It took a while to change behavior. But it seems that we're seeing now that increase in consumer spending. If you recall, we had that horrific drop in consumer spending in the fourth quarter. The December data was just horrible. And it's turned around. And economists are scratching their heads. Well, families are realizing that $25, $50 a week is permanent. So that's $100 a month, $200 a month some families are seeing. And this breaks it down by state, shows it's all across the country. This is really significant. In 2008, if you recall the recession, the stimulus plan that was introduced in early 2009 by the Obama administration included a waiver on payroll taxes for a time. And it was going to amount to about $25 a month or so for the average family. And the Obama administration said, that's a pizza dinner for the average family that we're giving them every month. That'll help spending. This is a pizza dinner a week. This is enough to fund an after-school activity. This is significant, and families are now incorporating it into their spending plans. At first, it was going to pay off debt. Now it's going to improve spending. So tax relief, getting a lot of bad press here on the left side, doing a lot of good things here on the right side. That subtly changed the tone of the economy. Valuations, they're high. Here's PE ratio and the total enterprise value to earnings before interest, taxes, depreciation, and amortization. That's the bottom line. PE ratio, the top line. They both show the same pattern. They're both elevated. They can both go a lot higher. So valuations are high, but it doesn't matter if investors are bullish. Now, fundamentals are deteriorating. Longer term, this is something to worry about, but not right now. And net profit margins are contracting. This is a sign of higher cost in the system. This is potentially inflationary, but it's also not a problem we need to deal with tomorrow. This is a longer term problem. It indicates when that next bear market comes, it's going to be deep. We just don't know when it's going to come. Price action says a large gain is possible. A lot of attention being paid to the major indexes, the S&P 500, the Dow, the NASDAQ 100. Small caps have not fully recovered. Small caps just now giving a buy signal. We had that big decline. We had then had a lot of consolidation. We had an initial break of that important resistance level, a throwback, and now it looks like that was all successful. It's bullish. 13.9% price advance to hit the target from here. That's a pretty big size gain, and we could see it happen quickly in this market environment because of sentiment. Every week I look at earnings and I got to question why. Well, earnings season tell us about sentiment, and it's not so much the absolute value of the earnings. Earnings, maybe it's best to think of them as a game. Analysts are paid to publish estimates of earnings. They need to talk to management to get the estimates that they're going to publish. Management doesn't want to miss earnings estimates. So if an analyst is overly optimistic and the company keeps missing expectations, management's going to cut that analyst off. So just the way the world works, analysts are going to try to come in close to the actual earnings, but a few cents below. The ultimate analyst would probably be 2-3 cents low every quarter. Management is doing their best to beat expectations. The stock rallies when they do. Because of the way the game is set up, we really want to look at that reaction to earnings, and that's what's going to tell us whether investors are bullish, bearish, conservative, aggressive. We're going to get a lot of insights from the numbers. Right now, what we're seeing so far, almost half of the companies report it. We're seeing an average quarter so far. 77% of companies reporting it beat expectations. That's about the one-year average. Earnings per share is coming in pretty much about 5.3% above expectations on average. That's right between the 1-year and 5-year average. 59% beating on revenue. That is the 5-year average. The number, sales are just 0.3% above expectations on average. That's a little low. That's partly explaining why we're having some trouble seeing profit margins maintain their record levels. Sales are lower, fixed costs a little bit higher, fixed costs the same to higher. So margins are going to contract unless companies can find a way to grow sales. We're seeing this quarter a lot of price increases, so maybe this number will turn around next quarter. This is important. Traders are focused on misses. Company beats earnings, average response so far. Company misses earnings, traders are selling sharply. And that's what we're seeing right now. So we're not getting any major insight from the earnings beats right now. Revenue beats lower than average. This is a concern because it shows companies are going to have a hard time maintaining margins when that bear market comes. We're probably going to see almost a collapse in margins. So we're going to see a very deep bear market. Now we have lots of factors pointing to the reality that next time when this bull market does end, we're looking at a 40 to 60% loss in the average. I'm not saying that's happening soon anymore. It's happening sometime. And the big insight, that larger than average decline we're seeing on misses. Traders are just anxious to get out of losing positions and move on to the next winner. It's a FOMO type market, fear of missing out. And that supports the idea of a market based on sentiment. Traders can't afford to wait for a company to turn around in their mind because they need to get into the next big thing. So sentiment is driving this market. Now, I believe everyone should read a newspaper because you see all kinds of little things when you actually turn the pages of a newspaper. And I use the New York Times, which is why I often quote from that. And an article this week noted the stock market is off to its best start since 1987. So I chart it here. The start for the year to date, 1987 is the black line. As you recall or may recall, 1987 was a great start to the year. We had a strong rally, consolidation, quick upturn, crash, more than 20% in a day. It's kind of ominous that this stock market is off to its best start since 1987. Doesn't look exactly like 1987, but looks kind of interesting so far. We'll be watching this. In my opinion, prices are moving higher. Fundamentals don't account for the gains. Economic data doesn't account for the gains. This is sentiment. It's likely to end badly, but we don't know when that end is going to come. We should see a downturn in breadth prior to that. In particular, breadth and other indicators will confirm that. So we'll be watching for the end and ready to jump out of this should it happen. But for now, the market does look strong. Again, this is Mike Carr. Thanks for joining me for a look at the market this week. And also, pay attention in the coming week for the Fed meeting, the press conference Powell will be holding after the Fed meeting, unemployment data on Friday, and the ISM data that'll come out on the first of the month. Every one of those events could be market moving, so pay attention to the sentiment associated with each of those news events. Thank you.